Good morning, good afternoon, good evening, and welcome to the TGI. Thank God it's Friday, the 21st of October. Bull versus Bear webinar. Steve Miley on the call for TradeDay.com. Welcome, everyone. We're going to go for our kind of usual regular run through, slightly different order today. I'm going to kick off with the Fed tool, but we're going to go and take a look at what's impacting markets right now from a fundamental macroeconomic perspective. Take a look in at the calendars, both the macro calendar and the earnings calendar. We'll also take a look at some articles from the major news wires to hone in on those macro fundamental events. And we'll take a look at the charts to see where the potential trigger points are in today's markets that I know you guys are looking at. I'm going to kick off in here with the Fed tool. And the reason I'm doing that is that, sometimes, different things influences stocks at different times. And I know most of you guys are trading the stock indices. And at the moment, it is very much the bond market and the thoughts around interest rates that are the kind of the dog that's wagging the tail of the equity markets. Despite earnings coming through generally positive, every kind of negative, overall, we'll take a look at the calendar, but I mean, most of it's coming in, above expectations. I reckon, 70-80%. But every negative number that comes in gets all the headlines, and the broader market seems to sell off on that. So on the earnings side, the market not taking any solace from the fact that we're getting actually decent earnings coming through, and all the focus really on the concerns around higher rates going forward and ongoing inflation. And so, and that's really come to the fore again more recently. I don't think there's been a specific event that's driven this. I think more than anything, I mean, there have been obviously the turmoil from the UK, but that was a few weeks ago. Saw a big move down to lower bond prices in the UK, and saw contagion effect and higher yield prices. But if anything, bond yields in the UK have been going the other way, have been going lower since we've had the subsequent developments with Bank of England intervention, and then the Prime Minister resigning over the last 24 hours. And the new Prime Minister potentially going to be in place, they're talking about, as early as Monday. We did warn you of that. I know the market popped on Truss's resignation yesterday. I hope you guys were, I did give the heads up that was on the way. There was a lot of rumor around that. So hopefully you guys were aware of that and didn't get caught the wrong way on that one. But I think, the big driving force has been this push for treasuries to lower prices, higher yields, and for then the interest rate, the short-term interest rate curve, which this Fed tool is just a reflection of the Eurodollar call. So this Fed Watch tool is calculated off of the, you can go and take a look at the methodology here. I'll share that the link. But in here, it's probably is a Fed rate tool, so it's calculated from the 30-day federal funds futures, so Fed fund futures. So this is basically taking it off of what the market is predicting. Okay, so there's the methodology there if you want to go into all the details of the maths. You don't really need to know all the details of the maths. What you need to know is, at the moment, we've definitely seen, I think there's been a shift slowly. I've been talking about, if anything, Bullard, when we spoke about Bullard, was kind of almost backing off a little bit, saying, well, once we hit, where we need to get to, it's probably going to be a matter of holding rates there for a while. And, at some point, we need to sort of, pull back from this very aggressive rate hiking cycle. And he was the one that really kicked off the more aggressive tone towards higher rates and called for those 75 basis point rate hikes. But, Kashkari, who was a dove, is now more middle ground, still calling for, to be very hawkish. So we have seen a shift, and this is the important part. I mean, this hasn't really changed at the front end of the curve here, so kind of nailing on the next rate hike. This is slowly increased over time, that we're going to get 75 basis points at the next meeting, and very likely now at the one after that. So the November and December meetings. So adding on 150 basis points between now and year end. However, it's kind of, as we move into the first part of next year, we get to February and then on through March, you see the peak in rates now. The peak in rates was previously this highest level, the highest probability for the peak in rates was to be at 475 to 450. Now it's at 5 to 525. So that peak is definitely higher. And you see it here going out through May next year, staying at those elevated levels. And if we go through to the end of next year, it does then dip back. So looking for potential, the market's kind of pricing in potential for the rate cut to come in here, maybe September through November, sometime around there is potentially. But what it's saying is, although we've got the rate cut as out there on the horizon for maybe about a year's time, the peak in rates at the beginning of next year, February, March, is going to be at a higher level, maybe 25 basis points higher than where we were before. And that's also being echoed in here. And this has been, I think, over time with the Fed speakers over the last week. This hasn't been a rush. It wasn't one announcement. And you can see that, in the yields, in the Treasury futures in here. So this kind of grind, it's been quite aggressive, but, well, not aggressive. It's not really that aggressive. We haven't had that many moves like this one here. Okay. It's been a steady decline in price, with some consolidation around the old lows. And then, consolidate. And then the last few days, we've had this acceleration lower in prices on yield. And if we go take a look at then the yield, so that was on the prices, lower in prices, sorry. And if we go and take a look at the yields, yesterday, continuation higher in yields. And this is dragging stocks down, right? This is, stocks feel to me like they want, so you've had that, sitting around. This is the 10-year yield. It was sitting around the 4% level. We nudged above it, 401, 402, 40, up to 410 at one point, 409, hovering. And then since the 19th, so 2 days ago, an acceleration really, more forcefully through 4%. Holding above 4% and then accelerating. Now we're at above 4.25 already. All right. So you've added on 25 basis points here on the 10-year, and kind of added on 25 basis points at the peak in rates that we have on the short-term interest rate curve when we look at the Fed funds rate potential from the Fed tool. So all of that, I think, is the big driver for. So I think it's super important if you're trading stocks to have an eye on the Treasury. Well, the easiest place to have it is on here on the futures. And if you're trading off very short-term charts, put this on a short-term chart because, the correlation is fairly high at the moment. This latest move down has weighed on stocks and kept stocks down. If this reverses, I'm not saying it's going to reverse, if it does reverse or show any signs of reversing to the upside, it will be potentially for a signal for an encouragement for stocks to rally. And you can see, importantly as well, you see this trend line, it works really well. We've got this accelerated trend line. It comes off the 4th October peak through this peak here around either the 30th. You can draw it off either the 13th or the 14th peak. And it respected it 2 days ago. It was going right towards it and then accelerated, impulsive move away from that trend line. I'm not saying it's going to get back up. It needs to get back above yesterday's high to reverse the trend line. But any kind of signal that this is going to move back higher could be a trigger for stocks to move higher because they're obviously very much at the moment, the last couple of days, having had a really strong rebound. We'll come back to the charts and look at the actual trigger points for today. But I think it's important we recognize this is the driving force, to the kind of, and it's not abject weakness in stocks. I think stocks are actually doing well considering this move, right? Considering if we go back to the yield chart, considering where we moved all the way down here. So the beginning of October, when we get this move lower in yield, we were at 355. Now we're at 425. We're 70 basis points. We're 0.7% higher in yield on 10 years, right? That's a massive move in a couple of weeks. And given we've done that, so that's from the 3rd, 4th of October. Go and take a look at where we are on the stocks from the equivalents. Let's go and put the S&P up. So 4th of October back here, when we put this low in here, okay, when we started to rebound here, kind of in here at the same place in stocks, right? So given that we're 70 basis points higher in yield, this is the 3rd and 4th, this move here, this big impulsive move back higher. Given that, back then, we're 70 basis points higher in yield on the 10-year than we were back here. And we're kind of in the same place, right? Roughly in the same place on stocks. So they're actually holding in very well because they could be on the back of that all the way down here. Obviously, the NASDAQ, you've got underperformance on the NASDAQ here slightly because of, say every time, but Higher yields, higher interest rates, more negative for growth stocks, and you have a load of growth stocks stuck in the Nasdaq. Right, we'll come back to the charts shortly. Let's run through. So I just wanted to point that out, make that clear. This is important. This is where the correlation, this is the driving factor for stocks. One of the driving factors, if it turns around, obviously stocks for me, they're holding up relatively well given the weakness in treasuries. If treasuries can get any kind of bid going, move to the upside, then stock indices could see a significant push higher. Right, let's have a look at what we've had and what we've got coming up. Retail sales in the UK overnight, poor data, so seeing a slowdown already. We have further retail sales data out of Canada in 48 minutes. Probably not going to have too much of an impact. 9:10, we get Fed member Williams speaking, 9:10 Eastern, and then really nothing else of note in here for the balance of the day. So a light data afternoon. 5 things to know to start your day. So Biden administration is exploring the possibility of new controls on China's access some of the most powerful emerging computers. So that's not good, right? That's negative in here. Twitter share tumble, pre-market trading on Friday reports that Biden administration officials discussing whether the US should subject some of Elon Musk's ventures to national security review. So a Musk in the spotlight, pushing Twitter down. Liz Truss's resignation Thursday, a lightning quick contest to find the replacement. It looks like it's either going to be Rishi Sunak, Penny Mordaunt, but also Boris Johnson. Unbelievable. Potentially back in the frame. But there you go. Rishi Sunak is the hot favourite at the moment. US equity futures down yesterday and dipping again in here overnight. And similar story in here from Reuters. They got their Take 5 Westminster Woes Tokyo on yen watch. So dollar yen in here continuing to push to higher levels in here. Dollar strength, yen weakness. They intervened back at, where was it? 140. I can just bring it up. Let's see if I can quickly bring it up here for you. I got dollar yen. Where are we? So have I got dollar yen here? Should have it. Here's dollar yen. This was the intervention. So when it was breaking, when it probed at 145, when it got above 145, this is the intervention back here on the 22nd of September. A lot of chatter that when it broke 150 yesterday, they may have intervened. Boom, taking out 150, no intervention. The market's slightly hesitant yesterday. And so, right, okay, if you're not going to intervene, we're taking this higher. So the market's rallied up to 151.5 now, 150 dollar yen. So lots of chatter. Given that they intervened back here at 145, we're now another 6 cents higher, 6.5 cents higher from 145. So what's that percentage terms? 5%, right? Best part of 5% up. So let's have a look. Just do it on here on the ruler. This is where they intervened before. Where we are now, we are 5.2% higher. Okay, so from intervention point. So yeah, there's real risk in here for an intervention, but at the moment the market's just ploughing higher. So that's what they're focused on here. Who rules Britannia? So leadership context in here. Determined dove, hesitant hawk, the Bank of Japan. Yeah, so Bank of Japan in here, 150. Well, so the ECB expected to deliver another 75 basis point hike next Thursday. And what else we have? More than 300 S&P 500 comes usual results for the next 2 weeks. Yeah, so we've got a lot of we've had decent results so far, but you've got the next 2 weeks are seeing a majority of the numbers to come in. Okay, what else have I got for you in here today? Stocks drop as yields keep rising. We've covered that. Pound weakens. What else do we have in here? Dollar yen. We've spoken about that already. Global bond yields break new milestone. US 10-year rate hits unseen since financial crisis. Traders bet on Fed rate peaking now at 5% after Harker comments. I didn't see those Harker comments. Okay, so what Harker? Where were we? Missed those. Okay, Federal Reserve officials like to raise interest rates to well above 4% this year and hold them at restrictive levels to combat inflation. Yeah, okay. So fairly hawkish comments from Harker yesterday. Nasdaq slide, snaps ad warning, knocks down social media. So we've had this as well. Social media stocks lower in here after Snapchat lost more than a quarter of its market value in pre-market trading. Slowest quarterly revenue growth in 5 years from Snap. Boris Johnson, Rishi Sunak, lead race to be next Prime Minister. T-Bod tension, Snap sentiment. So again, treasuries, focusing on treasuries. US Treasuries tumble. Some investors say turning point is near, but doesn't seem so right yet. Right now, dollar yen 151. We're way through that now. And where are we on the bourses going into today? So let's take a look. We're down about 1 to 1.5% in Europe this morning. DAX 1.3, CAC 1.4 in here. What else do we have? 1.2 at the moment, actually. The DAX FTSE is only down 0.2%, but nevertheless down across the board. And US futures in here this morning, having had a dip lower yesterday. Not a huge, we're up for a lot of yesterday's session. Late sell-off saw us give up a little bit of ground into the close, and we're not hugely lower. But again, look, NASDAQ leading the way lower in here this morning. Right, let's take a look at some of the charts, few of the trigger points. Oh, just to remember, I remember in here, guys, do remember in here, we do have that Trader Mind session next week on Wednesday the 26th. It's 1600 my time, so that's UK time. That's 4 o'clock in the afternoon. That makes it so 6 hours ahead there in Central time. So it's going to be 10 a.m. Central, which means 5 hours before 4 o'clock is going to be 11 a.m. Eastern. Okay, so 11 a.m. Eastern, 10 o'clock Central, and 4 o'clock UK time in here on the 26th of the month, 26th of October. Next Wednesday, we are going to have our Trader Mind session. Right, let's run through some of these levels in it. So we'll start with the NASDAQ. Sorry, the S&P. So yeah, I mean, this is not an aggressive sell-off, more of a grind lower and then grinding lower and bouncing in here today. We did take out so we've previously showed this support in here yesterday. We took out this, made a little double bottom, and then the market failed and obviously back lower into the latter part of the session and grinding lower in here today. I've got no strong view going into today. I mean, I think it's really, this could easily go either way. I mean, you'd have to be slightly negative going into today, I think. You have taken out some supports. So slightly negative going today, but not aggressively so. I think you just have very short-term trigger points through the current low or back above this little peak in here. So my short-term triggers in here, 36.79.75 or below the current low is 47. So 47 or above, really like kind of 80 in here. Are going to be triggers. Just breaking out this little range, I think, initially. That's all I'm going to be looking for. There's no real good trend lines in here. And then on the downside, no significant big support levels to be monitoring. So for me, just look at the very local breakout levels, and it's going to be the same for the NASDAQ. Grinding low. It's not an aggressive sell-off in here. And as I say, from a macro perspective, from looking at the correlations, for me, I'm kind of, I'm still hanging on to the bullishness given that where we are in treasuries. So, the market's trying to base in here. But again, back through the current lows from overnight, 10,966.75, the low, or back above that little spike there. Just the recent high lows in here for me are the trigger points, 11.010.75. I'll just be playing those. You got this kind of little tentative trend line that runs across here. You could maybe, if you want to get in earlier, go through that, I guess, in here. But I mean, it's a real tricky one at the moment, because if you look at the dailies, we're kind of a bit in no man's land going into the day. You got the base put in place, but the market is then drifted lower and doesn't really want to reinforce and confirm that short-term base. And same on the S&P. Base goes in. I called. After that that day, after that's the CPI day, the 13th. That I said that was the bottom. I still feel that that's going to be the bottom, but that's no good to use a day trader, because now we're kind of sat in no man's land. We're kind of halfway between the low and the recovery peak in here. And you got these peaks over here. The market hasn't confirmed above these peaks over here from the beginning of October, so the market's kind of a bit in no man's land. And given it's Friday, given we have no data, I wouldn't be surprised it's for a bit of a chop day. So that's why I'm saying no strong view, be flexible. If there's nothing, concrete in there, you're not getting your signals, don't take anything. Don't try and look for trades. It could easily be a bit of a chop day in here today. Let's go take a look at gold and oil. So gold in here for me is still very negative. We did this morning go down right to the low in here, stayed negative on gold. 1622.2 the low this morning. We got down to 21.1, so just pipped below there and then bounced. If we step into the 15-minute chart, for me though, it's not done enough on the bounce. You can see hesitant around these resistances. You've got resistance in this area from like 1631 through like 33, and the market's kind of hesitant there. If we get above 33, this could pop higher, but underlying theme is still very, very negative in here for gold. Let's take a look at oil. So a rebound failure yesterday, and then a dip and a rebound in this morning. You look at these last two candlesticks, the candlestick from yesterday and the candlestick from this morning. Indecision, right? Look at the indecisive candlestick here. So we've got long-legged doji here. Then you get the sell-off 3 days ago, then rebound, and then rebound failure, dip, and rebound. Chop fest, right? No strong view in here from these. These two last candlesticks, well, yesterday's candlestick and this morning's candlestick, opposite directions, telling you the market does not know what it's doing. And that was hinted at back here by this doji pattern here. Since then, you had big sell-off, big rebound, right? The market can't make up its mind. So again, could easily be look at that. I mean, where do you pick to go long or short in that? I don't think there's a trade in there, right? If it clears above these peaks here, this peak here, you've got potential little bottoms up, but I think it needs to get above there. I wouldn't have wanted to buy it till 85.19. Above 85.19, yep, we could pop up to it was like 86.5, but whilst below 85.19, no view. I don't want to sell it there though, really. Don't want to enter short. So yeah, chop fest. So not a lot out there for me, obvious today, and it could easily be a bit of a sideways choppy day. So just watch out for that today. No news to drive us. End of the week, been a choppy week. Market kind of indecisive. So yeah, we could easily see the market sit this one out today. And so don't get pulled into trades you don't need to today, guys. I would suggest. All right, I'm going to wrap it up there. Reminder, next Wednesday, Trader Mind session, 10 a.m. Central, 11 a.m. Eastern, 4 p.m. UK, 5 p.m. if you're in Europe. I'll be back with another Bull versus Bear webinar on Monday. Till then, have a great trading day. Have a great weekend too. Take care.